Welcome in and welcome back. We are here for a weekly feature on the channel that I call the Weekly Investor, where we talk about three stocks that I'll be watching this week, as well as any business stories or news that has caught my eye along the way. And if you are watching this, you are watching this on what is a substantially bigger channel than it was just last week. I put out on all of my social media and on my other channel, which is Strip Coverlet, where I do book, short story, and poetry reviews, that we will be doing a 150 subscriber Q&A once we hit that number here. And in the wake of that, in response to that, we have grown by, I believe, 22 subscribers here. So you are more than welcome to leave a question in the comment section if you would like me to answer something. But other than that, let's get right into it. The first thing that I'd like to talk about is a story regarding what has been for 4 years now the largest holding in my am I crooked? I can't tell. I got a new stand, and it's been very difficult for me to use and put in place. But the largest holding in my portfolio, and that is Microsoft, ticker MSFT. They have officially acquired Affirmed Networks. This is a 5G player that, according to Frederick Lardinois at TechCrunch, is a fully virtualized cloud-native networking solutions for telecom operators, unquote. I think that's a big deal. I think that's a big deal for someone such as Microsoft, who is moving much more into the business-to-business world. This is going to bolster their business-to-business capabilities, especially as the 5G revolution is going to put some companies on the map and possibly put other companies under. And there is a part of me that wonders if this acquisition is in response to their defense contract that they just signed. As 5G and security implications thereof, this may be a vital acquisition. The next thing I would like to talk about is that, and this is going to be brief, so don't get too bent out of shape about this, because I mention this company basically every week. Tesla. Tesla reported their earnings and shared a surprise profit. I'm not going to go too deep into that here, because I did an 18 or 19 minute video on a response to their earnings that I posted last week, the day that it came out. If you want to watch that, go over to the videos tab. It's not going to have my pretty face on the thumbnail. I made the thumbnail just the Tesla logo. The next thing that I would like to address, Alphabet, Snap, and Facebook all reported surprisingly strong ad-based revenues. Facebook spiked $20 per share in the wake of this, and Alphabet/Google spiked $110 in wake of this. And the reason that I think that this is something worth noting and watching, especially going forward, is it makes me wonder if this is when new media finally starts pressing the screws to legacy media. The ad dollar is what has made legacy media go. And now that new media is in the place where they are expecting profitability, they may collectively understand that it is in their best interest to accept as many ads as possible for as low of rates as necessary to start eliminating some of the legacy media players. And I think if that is indeed what is to happen, we will start to see a consolidation of legacy media players instantly. Because one of the things that you have to be cognizant of, and you must be cognizant of if you are on this platform, that this platform being YouTube, is how quickly and with what precision legacy media has been able to take up arms, aim at one creator, notably, often PewDiePie, in an attempt to discredit the platform, in an attempt to get the ad dollars off of the platform, in order to get ad dollars off of new media so that legacy media can keep those ad dollars. So I think that the veracity with which those attacks have often, possibly always, come, added to the fact that they have moved oftentimes in unison when they were not bedmates before. There were coordinated attacks on PewDiePie. I think when you pair those two things, it becomes pretty evident they're paper tigers. They were a lot weaker even than they seem. They were a lot weaker than they care to put out. And the fact that they control the narrative is only that they control the narrative because they have the largest megaphone. Or they think they do. I think new media has been more apprehensive and slower acting to try to put the screws to them than they could or should have been to this point. And if they start doing that, watch for legacy media to have another backlash, first of all. But second off, how quickly they're going to fold and have to consolidate into one another. So that's something just to watch there. And the final story before we get into individual stocks is to say that Boeing, ticker BA, has shunned government money in favor of raising their own debt, and they were reportedly overwhelmed by the demand for that debt. This is, as we stated last week, in partially, this is very good news. Kathy Wood from ARK Invested also mentioned something like this, and I reported on that in the last Weekly Investor. But the fact that the company themselves stated the fact that they were overwhelmed is quite telling, I think, because it is a sign not only that Boeing is positive they're going to survive this, but that level of individual who has millions or tens of millions or hundreds of millions or possibly billions of dollars to loan a company like Boeing in order that they may collect the interest on it, that level of individual is positive Boeing is going to make it and is willing to loan their money out because they think they're going to get a higher investment or a higher return rate there than they will in A, riskier assets, but B, also, than they will leaving their money on the sidelines or putting their money in savings accounts or bonds or things like that. But it's also telling that that level of individual is positive that their money will be returned with the interest, and possibly in a timely enough fashion for more money to be made on that money with the interest levels accrued. So I think that is worth noting. It is worth continuing to note, and it is worth, if it's possible, to dig deeper into that. I'm going to try this week to find out a little bit more about those numbers which have been involved. Now, 3 stocks that I am watching this week. Number 1 is VWO. This is the Vanguard Emerging Markets Fund. It is trading right now at about $35, bottomed at $30, and that was as well its 52-week low during this crisis. And it has a 52-week high of $46. So has this pandemic hit a cooling period, and where has that cooling period happened? I think that when you're looking at an emerging markets fund, you are inherently looking at a fund that is taking place in economies which are lesser able to deal with this type of pandemic. And if those markets are seeing a cooling in the panic that has happened and will happen in wake of something like this, are we already on an upward trajectory economically at a world scale? I think it is also worth noting that the Vanguard High Dividend Fund, VYM, has a quoted 2.89% dividend payout. Right now, the Vanguard Emerging Markets Fund has a 4% dividend payout cited. Obviously, with things like this, it is always possible for those things to turn. We've seen a number of companies cancel their dividend, suspend their dividend, reduce their dividend during these times. But what is it? I think so. 2.89 versus a 4% dividend yield. That is a 1.11% difference. That is not something which is marginal. That is not something to scoff at. So if that third world type emerging market fund that is profiting from those businesses in those areas, businesses in emerging markets are also normally more volatile on the downside, that they are more susceptible to collapse, but also they are more prone to if somebody gets it right, they're more prone to the 10x type returns as well. And those 10x returns are those are the returns that make millionaires. So I think that is something I'm going to be watching. That is a fund that I very much want to be in. I think especially as when you're talking about a technology like 5G, you're talking about a technology that is going to widen the gap between prominent market and emerging market. That is true. But you're also talking about a technology which it's leaving behind 4G. 4G will become more readily available and more affordable, which is going to revolutionize some businesses in emerging markets. You're also talking about if a company is able to get its hands on 5G technology, it is able to more quickly, more promptly, more prominently expedite its emergence in an emerging market, take a higher market share in a market such as that. The next stock I'm going to be watching is one I will be watching basically out of morbid curiosity going forward. The aforementioned Snap. Difficult to believe. Snap has been public for 3 years now, about 3 years and a month. 3 years and 2 months. 3 years and two. It went on March 3rd, 2017. It went public. It went public at $27.09 per share. It is currently around $17 per share. Its 52-week high is 20, and its 52-week low is 8. So the volatility between 20 and 8 versus that high where it hit the market at 27, and it's still losing money. I believe only one of its past 4 quarters were profitable. It lost 8 cents per share last quarter, and I think it's necessary at this point, 3 years into being public. Where's that money going? You're not talking about a company that one would imagine would have a terribly high capex, and Snap is a $24.5 billion company. So that's your valuation. Where's your capex? What are you buying? What are you doing with that money? It is not a company that I am particularly well versed in. I am not a social media mogul. If you know anything about me, I deal in these things mainly, not computers. I deal in books. That's why you're seeing this being shot on a cell phone. But it's strange. There was a period after a lot of companies recently have gone public, they have debuted very high and tanked. Twitter, for example, which is, I think, an apt comparison considering they're both social media, considering Twitter went public at a much higher rate than it traded at afterwards, and has rebounded a bit. Twitter, for all of 16 and all of 17, all of 2016, all of 2017, Twitter was dead. Twitter was flatlined. They have recently, fairly recently, I think it was the last quarter of 18, were revitalized. They've had a little bit of volatility since, a little bit of volatility here and there. Twitter is a hellhole, for what it's worth. It is enough to make me wonder if the current $17-ish range for Snap is that 2-year dead period where you'd better figure something out and you better become profitable. You better revolutionize your business and your platform. Otherwise, you will disappear. Twitter managed not to disappear. The final company stock that I will be watching this week is one that I do already own a small position in, and that is CocaCola, ticker KO. The aforementioned Microsoft pinned a 5-year deal with Coke for tech and logistics. Now, this is new to me. I did not know that apparently Coca-Cola is fairly notorious for being outdated in their tech and logistics. Or maybe I was just reading some skewed articles. But could this be a long-term work from home play? There have been a number of companies that have been talking about, in the wake of this pandemic, the fact that their work from home strategies are fairly comparable to the work that can be done in an office. So why are we paying rent for all these offices? Why are we leasing these office spaces? Why are we making our employees drive 40 minutes into the office, waste their gas? Why don't we just cut down the office space? I've seen numbers between 15 and 40%, not in correlation with Coca-Cola, but I have to wonder if there is some thought going into that. And it makes me wonder, was it WeWork? Was that what it was? That was basically like you signed a membership to lease office space, sort of, for access to office space that went terribly. I wonder if there's going to be a bigger, if companies are going to start making their office spaces in that image and fashion versus you've got your corner office, yada, yada, yada. If it's going to be sort of like a library experience, a university library experience at that, where you could go and you recognize, oh, there's Blair from my advanced logistics class. Let me go and say, hey, did you understand this project? You know, things like that, where you've got more open space. With sort of in the way a lot of tech companies have reportedly been doing them. Google apparently has a lot more open office space than the closed. You've got the corner space, you've got it over here, you're in a cubicle type deal. I think that could be something that is on the horizon. And in addition to that, some negativity has apparently crept back into Coca-Cola and Pepsi, as both of them have seen their post-flash crash highs and have been sort of sinking back towards them recently. But Pepsi trades around the $130 mark, meaning that Coca-Cola trades at around 33% of the sticker price that does Pepsi. But the dividend yield from Coca-Cola is a higher percentage than that of Pepsi. Lower dollar payout, but a higher percentage of the sticker price of the stock. So what is the play there? What is the correct play? And how do you go about that? That is all I have for this week's Weekly Investor. I would be interested if you were watching any stocks this week. What business stories stood out to you? And again, if you have any questions for my 150 subscriber Q&A, I would be more than happy to see them in the comments below.